Hello, everyone, and welcome to another VSM Real Estate Podcast. I'm your host, Daniel Krakowski, joined by Goran Vazovic.
How's it going, everybody?
You heard me want to say Monday Motivation.
I
was feeling it.
I'm waiting for you to mess up so I can just say it, but you're not messing up. So
far, I'm batting 1,000. Yes.
Yeah.
We also are joined today by Allison Rudine from Classic Property Services.
Hello, everyone.
What's up, everybody?
What's up, everybody?
There you go.
Very happy to have you here.
You did a podcast with us
Yeah,
already.
it's been like 3 months.
Don't be shy.
And the reason Allison's here, she actually made the connection for us, and we're super excited to hear. You may know him by his NMLS number, which is 328-929. No, I kid. But we're joined today by Dave Sawicki from Wintrust Mortgage.
Yeah, thanks for having me. I'm excited.
We're excited to have you here, and what I'm really excited to talk about today is, we've had a few other lenders on in the past, and, they focus on, millennials. That's been a big one.
Mortgage stuff. No one has talked really about the 2 or 3K loans in depth.
Yeah, so what we get to do today is talk a little bit about something that touches all of us a little bit more. Us on the investment side at VSM, Allison on the construction side over at KPS, and then, of course we have the expert, the glue that holds all this together, the guy who puts these loans together, gets people into properties in a tough market where, the dream house that you're looking for may not be available for sale, but if you can build it, then you're really in business.
Absolutely.
So,
or renovate a home at a location that you want to be at.
Absolutely. So
best kept secret in real estate.
It's crazy.
That's what we want. Tell us about, and our viewers, the best kept secret in real estate.
Oh, I could talk about this all day. So I think the best way to get started is, this is something that is not new. I've been in the business since '96, and back in 2007 and everything else, when things hit the fan, I'll just give you a little background on how I got into this. I was sitting around going, "Hey, do I want to continue with, just writing loans and blah blah blah, and what do I want to do for the rest of my life?" Well, a friend of mine introduced me to renovation loans, and at the time 203K, which is everybody knows that as kind of the buzzword for renovation loans. And before that, I would get calls from my customers, and they would call me and they'd go, "Hey, Dave, we got this great house, but it's got a 1950s kitchen, and we love the neighborhood. We our church is just down the road, and kids want to go to school there, but God, we hate this kitchen, and we don't know where we're going to find the money to do this. Buy the house and then update the kitchen, and we don't want to do that 5 years from now because we're going to be ready to buy another house."
Right.
And I'd go, "Well, you can't really do that." and that's what most of the people in my business were telling people, and I was no different. And the reason being, even though I knew there were loans like the 203K, I believed at the time, like a lot of people, too much work.
Yeah.
Too hard, too difficult. Okay, you got to get a contractor involved. Contractors hate paperwork.
Yes, we do.
So this is a real problem.
They still do.
Absolutely.
So anyhow, a friend of mine said, you've got a bad attitude, and we need to fix that. And I'm thinking, well, and I need something I need to grab onto. And he walked me through it, and I started looking at the advantages that I brought to the table with these loans to my customers, and looked into the history. A lot of people don't realize FHA has had 203K loans since 1977.
Wow.
That's almost as old as me. But they've been around. They've been tested. So this isn't something new that is just a fly-by-night thing. I mean, the government is totally behind this with the FHA. Even better, now there's a loan called Homestyle. It's a conventional loan. It's Fannie Mae. Quite frankly, I've switched from doing mostly FHA 203K, which is still the buzzword, to doing primarily home-style conventional renovation loans. And here's the big thing. Now, when those people call me and they go, "Hey, we found this house, but it's got an Ozzie and Harriet kitchen. Can we buy this house and renovate with one loan?" Absolutely. Yeah. Absolutely, we can do this. Now, the thing I fight most now, and even though more and more people are aware of how this works, people go, "Well, okay, so how exactly does this work?" Well, it's really actually pretty simple. The big benefit to any renovation loan, whether it's a FHA 203K or a Homestyle, is that you get to use the after improved value.
Right.
Now, that may not seem like much.
ARV, aka ARV. We use that in the investment world a lot. So.
There you go. Yeah. Okay. So, and the advantage is you're obviously building equity. Okay, if you're going to buy a house and you're going to make an improvement to the house, whether it's finishing the basement, updating the kitchen, or better yet, expanding and adding square footage, you're adding value to the house. Right. I recently I had somebody where it just they caught the right deal, and I always tell people in addition to looking at the things like an updated kitchen and so forth, look at the deferred maintenance. And they found a house. All they did to it, I think they paid $170, $175, which is a little higher than the list. I was pretty nervous because they were going to put $30,000 into it, and I was afraid it wasn't going to appraise. The after improved value wasn't going to be enough, and because they were doing a new roof and new siding. That was the primary cost. And those things are not generally things that add a lot of value. But it turned out that they actually added value, walked away with an extra $10,000 of equity in the house. Wow. So the advantage is you're using that after improved value. You're building equity. Sometimes you're getting instant equity. I've had customers, now this is not the norm, but I've had customers that literally have the day of closing increase their net worth $50,000.
Wow.
I mean, it can work. And even in today's market, where it's a seller's market, you find the right property, you like the neighborhood, you buy the house, you add the improvements, you're building equity. The other thing, I get the question when people call, they go, "Well, that sounds great, Dave, but so how does this work? Do we get another mortgage? Is this, so forth?" No, that's the other nice thing about it. It's one loan, one payment. It's kind of like having a purchase money mortgage and a construction loan all built into one. You close on the house, the seller gets their money, they go away. You get a pile of money that we've determined how much because we've already got a final bid and got everything together from the contractor. We put that money aside. The contractor, here's the nice deal for the contractor. The contractor is guaranteed to get paid.
We like that.
As long as they do the job, they're guaranteed to be paid. Now, when I first got into the business, somebody told me that, and I said, "Well, what's the big deal? Don't they always get paid?" and then when I started talking to my contractor friends, and they would go, "Wait a minute. All I have to do is do the job, and I'm going to get paid." Yeah, because we control the money. Yeah. We control the money. So unless you screw something up, you're going to get paid.
Yeah, we're not going to screw anything up.
And better yet, we have somebody that monitors that and takes care of that.
Right. So you being here, also from a contractor's perspective, as far as getting paid or payments, is this a one lump sum payment in the beginning, or do you get paid at the end? How big of a hassle, if it's even a hassle, this 203K loan is from a contractor's perspective to even want to do the job?
Well, typically we get about half down from the bankers. depending on exactly which loan it is. And then once we are done with the job, that's when we get paid the rest of the money. Being a general contractor, this does not always happen. Sometimes we'll be told, hey, yeah, you'll get paid when the work is done. However, all of a sudden people don't have the money.
I've seen it already, even for you guys. Yeah, we do a $80,000, $90,000 job, and all of a sudden all of our work is complete, and 8 months later we might have collected 4/5 of it, maybe, if we're lucky. So something like this is absolutely what we love to hear, because we're here to make all the repairs on your house, but we also need to pay our guys out as well. Absolutely. Can I pause for 1 second and maybe take it back and hit some of the, because you did a great job explaining specifically the 203K, right? That's what we were focused on.
And the home style renovation.
So they're both. So the Fannie product is not. It's not considered subordinate financing.
No, absolutely not.
That's awesome.
They're both one loan.
So from the consumer, the first person, I'm sure there's a bunch of questions that you get asked very often, and I'd like to maybe get some of those on record so you're not asked them the next time someone who listens to this comes in. But questions that I have as well. So for the 203K, is that something that do the typical FHA rules apply? Am I only allowed to have one, excluding any extenuating circumstances?
Yes, it's an FHA loan.
Okay.
Period.
Yeah, that makes sense. Am I allowed to use that to purchase a multifamily property that I'm going to occupy one unit as a primary residence?
Absolutely. In fact,
that's awesome.
I've had plenty of people, especially younger folks, that are going, "Hey, we want to be the next real estate mogul, and how do we get started?" And of course, like most first-time buyers, they don't have a ton of cash. Well, FHA is a great program for that, and I always tell them, hey, if you're going to live in one of the units, go buy a duplex or a 3 or 4 family. And here's the really cool thing about it. You can use a 203K to update each one of those units. And you can use the rent from the units that you don't live in to help you qualify.
Oh, yeah. That's the best about it.
And you don't even have to have leases. A lot of people go, well, yeah, but I have to have a lease. No, you don't have to have a lease in place. We're going to use the appraiser's market rent to help you qualify. So what you've done is you've got into it with minimal money out of pocket. You've improved the place. If you're a smart landlord, what's the worst thing? Landlord's worst nightmare. What's landlord's worst nightmare?
Vacancy.
Not getting paid.
Other than vacancy.
Damage.
But broken down furnaces, right? Maintenance. So now, again, I would tell them, especially in this case, look at the things that you don't want to have to stick money into in the next 5 years and get those things updated. Get a new roof. Now it all has to come together, of course, but let's at least look at those things so you're not in a position down the road where you're going, hey, I have to figure out how to replace a $20,000 roof.
Right.
It's an awesome way for somebody to get started. Absolutely.
Yeah. The 203K seems in particular to be a great advantage to the investor who's trying to buy that multifamily and owner-occupy part of it. In my experience, at least from the conventional side, but not, again, from this particular program, you're coming into multifamily, you're then needing to come up with 15% down and are not able to use the appraised rental amounts for each other unit to qualify. Is that the case here?
Well, you're going to need more money down for multifamily. A duplex, I believe, is 10% minimum if you're going to live in one of the units. But no, that's not true. You can use the rent from the other unit to help qualify.
Oh, interesting.
Yeah.
Maybe I should be talking to you more often. But, okay, and I'm sure here's the most common question. But, Dave, how much is it going to cost me? What's the difference in cost for me in terms of the interest rate, in terms of financing costs up front?
Well, as far as the cost of closing the loan, there really isn't a lot of difference. You're building in some things into the loan that would normally be done with any kind of construction loan, like you're going to have inspections for draws and things like that. Mm-hmm. But when you put it side by side with a full construction loan, you'd look at the difference and you go, well, this is no big deal. As far as the interest rate, the interest rate's a little bit higher. But again, I think most people, when you step back and look at the big picture and you look at it, whenever you're making a financial decision, it's real simple. You go, okay, I've got options. Let's lay the options next to each other. So my option is I get this stuff done. I pay a little higher payment, which generally is not much because we're not looking at double the interest rate or anything like that.
Right.
Here's my payment, and I get all this work done. The other option, I buy the house, I got a little lower interest rate, and I've got a lower payment, but now I don't have the things done that I wanted to get done. Right. So now my question to you is, where are you going to get the money to do that, and how are you going to pay for that?
Yeah.
And if you go, well, I'm going to get a loan. Okay, well, add that payment to this payment over here where you're buying the house without the renovation, and then compare it to the renovation.
Of course, yeah. Mm-hmm. Always got to do, especially if you're the new hopeful real estate mogul buying your first place.
Yes.
Good to start understanding how to do those cost-benefit analyses.
Well, and a lot of times it's cash flow. If you can't cash flow a transaction, then you probably are going to have a problem,
right?
Regardless of what your interest rate is or whatever.
Just going back to the interest rate, is it a significant difference? Is it like a quarter point, half point, full one?
It depends upon the market. I would say,
so let's say right now,
my experience with FHA, it's anywhere from 3/8 to a half point.
Right.
With conventional, then it's more determined by what your credit score is going to be and that kind of stuff. What your down payment is, and I would say now you're looking at maybe a quarter to again a half a point. But there's more variables with the conventional.
Right. Yeah. I think it's something to consider. But when you look at it, as far as you're getting a home, you're also getting, a renovation, you're adding value, and, you could walk into instant equity where that interest rate may not even matter.
Yeah, I think, again, when I sit down with people, and generally we spend a lot of time with them going through all the numbers and how this all lays out. I have yet to have somebody go, okay, no, I'm not going to do that because I'm paying a quarter point or even a half point higher in the interest rate.
I could introduce you to some people who would say that. I'm just kidding. But no, it makes a lot of sense. And the thing with considering interest rates right now in general is there's not a lot of room. The difference of half a point seems like a lot right now because we're just so spoiled and used to it, especially people in my generation who are exposed only to interest rates, after 2008. That's when they're graduating high school. Mm-hmm. But if you can lock in an interest rate now, even if you're getting all these additional benefits, and your main concern is just, it's closer to 5% than I would like. Historically, you're destroying, the expectation for what interest rates are.
Oh, I would agree with that. Interest rates are phenomenally low.
I want to finance everything right now. I want to finance. I want to finance, a meal at a fast food restaurant.
All right.
No, go ahead. Did you have something to say? Or?
I did not.
Oh no, I was. I had a question regarding as far as how long does it take? So let's say I'm a conventional buyer. Mm-hmm. I'm ready to buy a home, but then maybe I want to get into a location that I really like, but the home is not as big and I want to do a renovation. What's the timeline? Is it going to take me 30 days?
That's a good question. Yeah. It really doesn't take much longer than a regular closing might take.
Okay.
The big difference is, and I tell people this all the time because I get that question a lot. Mm-hmm. I say, look, from the time I get a final proposal from Classic,
yep,
that's when the clock starts, and we should be able to get those closed in 30 days. Now,
that's not bad at all.
No, and so I'll tell you what. In today's market, it's real simple. If you're out interested in buying a house, whether you're going to be doing a renovation, whether you're an investor or whatever, you're going out to buy real estate. If you don't have your financial ducks in a row before you start looking, you're putting yourself in a bad position.
Right.
Okay.
No doubt.
So regardless of what you're buying, I meet with people. I spend about an hour in general, and this is whether they're doing a renovation or they're a veteran. They're going to use a VA loan. It doesn't matter, and I spend an hour with them. I know what their situation is. I walk them through what their options are. I explain to them what a bank looks at as far as qualifying. We get them pre-approved. My goal is when they're out there, I want them to be comfortable with their financing options, so they're not sitting there on Saturday night at 8 o'clock going, God, I wish I could get a hold of Dave. And not that they can't, but if I'm not always available, I don't want them doing that. I want them to feel like, I understand how this is going to work. I'm comfortable enough. Yes, let's move forward or let's not.
That's awesome to hear, because I feel like in your industry in general, there's a lot of people who don't necessarily do the work up front with the client to give them the understanding that they need to feel comfortable and confident throughout the transaction.
It just makes all of our lives easier.
So much easier, and it's just good business. It's what people want. People want to understand and be informed. So
I had a situation last night, and I got a call, and I still get the calls, and everybody does. You get the call from a real estate agent, and they goes, "Hey, I'm going to show these people a condo at 6 o'clock." I go, okay, and I'd never talked to these people before, and they go, well, I'd like to know that they're qualified, maybe even pre-approved. And I'm like, okay, really? Okay, we're I've got 3 closings.
Did you look at their bank statements? Yeah. If it says they got enough money,
I got 3 exactly. They're gonna pay cash, and it was one of these things where I got 3 closings today, blah blah blah, and I go, all right, fine, and we get all the stuff. They were supposed to meet. I forget what time it was, but by the time I went, they sent me what I needed to kind of take a look at it. They authorized a credit report. I spent a half an hour, looked at it, and then it was like, you know what? There's sorry, but there's no way. I talked to the agent, and I called and I said, sorry. Now I'd be happy to meet with these people and help them put a plan together. Mm-hmm. They had really good credit, but they needed a plan and an understanding of what it takes to get approved for financing to buy a house. And I said, I'd be happy to meet with them and do that. Well, it was funny because the agent was headed to the showing that they'd set up, and it was like, okay, well, I'm turning around, and they don't want to spend their time, and it's a hard thing for the buyer too, because the buyers they're going out there, they're getting all excited about buying a house, and then they get crushed.
Right. Yeah. And you look like the bad guy, even though.
Absolutely.
I think that's where the real estate agent should have been more prepared. And that's what we try to get everybody here, is really just do the work.
It's a hard thing to do, though.
Do the work up front.
Yep.
Set the right expectations.
It's a hard thing to do because I agree that in an ideal world, that's what should be happening. And I tell people all the time, look, I'd rather spend the time up front with people. And I don't care if they're going to buy in 5 weeks or 5 years, quite honestly.
Right.
And in fact, I got somebody right now that I'm working with that we're probably looking at something next year, and I'm really happy that I'm working with them now, because we've got some things that we can do that will put them in a better financial position a year from now. And if I remember correctly, there's no way they can do it now, but in a year from now, they're going to be in great shape.
Right. And there's nothing wrong with that. I think, just in any really job or career, you want to have a really good, strong pipeline, and some of those pipelines could be years out, and that's okay. You're going to be really happy when that business closes next year.
Exactly.
Well, I'll be happy, but more importantly, they're going to be happy.
Right.
Where I see them where they fall into traps is when they call me up and they go, "Well, Uncle Bob told me." It's like, oh, how long's Uncle Bob been in the business? And I'm not saying you shouldn't get advice from people you trust, but I think when it really comes down to it, you need to get advice from somebody who's looking out for your best interest, and that will help you plan. You really want to, and especially in today's market, if you're not prepared, you're going to get crushed.
Right.
Most of my customers are putting in offers on 3 different houses before they get an offer accepted.
Right.
It's a seller's market, and you want to know what you can do and what you can't do.
So to jump to another question that I had, what are the limits? As far as if I'm buying something for $200,000, can I also do a renovation that's $200,000?
The limits are real simple. The limits are the FHA limit for the loan amount.
Yep.
Okay, and for conventional, same thing. The conventional loan limit. Conventional limit is now 424.1 in the Twin Cities. That's for a single family. And FHA, I want to say, and I should know this, but off the top of my head, it's like 324 or something like that.
Okay.
It's for a single family, and then it goes up for duplexes, triplex, fourplex.
Right. So the lending limit is one thing, but then the limit on the actual renovation, as far as the current value, in the proportion to current value of the home, or the original
for FHA, there is no limit.
Okay.
For the conventional, your total renovation cost cannot be more than 50% of your after improved value.
Okay.
So if your after improved value is $500,000, you can put $250,000 in renovation, and the renovation costs are actually pretty simple. It's the cost that you pay the contractor. All renovation loans, Fannie Mae's Home Style and the 203K build in a contingency reserve because things come up in construction, right?
Yes, they do.
Things change.
Every day.
Change orders.
Well, and I tell people all the time, it's not change orders where they decide to change something.
No.
We won't allow that unless we know for a fact that we're not going to run into any surprises. A wall gets torn down and there's something behind it that everybody goes, oh my God, type of thing. So it's there to protect the consumer so they don't run out of cash.
Right.
So that plus the contractor's cost, inspections, 5 inspections for each property or for each loan, and inspections are maybe $150 a piece. There's a title update, $200. There's an admin fee to handle the administration cost of the draws, like $200, and permits get rolled in there, and some people go, well, why don't I just write a check for the permits? Yeah, you can do that. Most people just build them in. And then there's a consultant fee. That's the person that is our eyes and ears, and in a lot of ways, the consumer's advocate. They are, I like to call them project managers. They're certified by HUD. They have lots of experience in construction, and they help manage the project. They coordinate between the builder, the consumer, handle the draws, that kind of thing, go out and do the inspections and everything else. And their fees are based upon the size of the job. I think the max is $1,000. And that you total all that up, and that's your renovation cost. So again, you compared that to going back to your other question, or the question somebody asked about cost. When you look at that compared to the cost of a construction loan, it's negligible.
Right.
And if you don't use the contingency that's built in, pays down pays down your loan. It's just used to pay down your loan. Although, in 8 years, I haven't had anybody not use it. What happens is they get down to the end of the project and the HUD consultant will say, okay, yeah, we're not going to get any surprises. So they go, oh, so can we do this? Can we do that? Yeah, sure. Knock yourself out.
At what point do you guys step in? Let's say if people are, less fortunate and they're not working with Classic Property Services
I'm sorry to hear that.
on their renovation, as far as because there's a lot of contractors out there that,
right.
and the scale can go from one end to the other.
Mm-hmm.
As far as so I'm approved, I get a bid from my contractor, and I'm just I have a regular job. I don't know anything about construction, and I think the numbers are good. Do I then get that back to you, and then you send it to someone else that can actually validate what the bid is and if I'm actually getting the right price?
Actually, that's a great question. The system is set up to actually watch for or do that type of validation, if you will.
Okay.
What we're looking for is reasonability.
Okay.
And the first step in that process is the consultant themselves. They put together a work write-up that includes the breakdown that our underwriters want to see for the project itself. And it breaks down material and labor for each category and each line item that's going to be done. So if you took your sworn, you could basically plug it into this format. And it's a format that I believe everybody uses. It's a pretty standard format. So the first line is that the consultant's looking at that before we even get it and goes, this is reasonable. All right. People call me all the time and they go, well, I'm going to work with my buddy Joe.
Right.
And I tell them, I go, look, I don't care. Work with your buddy Joe. I hope you get a good deal. But just know that we're going to vet Joe. We actually call references, both business references and customer references. So
so the background check, and then do you verify their licensure?
Absolutely.
Make sure they're bonded, insured.
Absolutely.
Work comp, all that stuff.
Oh, absolutely.
Okay.
That's part of the process. Absolutely.
All right.
And so, we're looking at exactly that kind of thing. And if somebody comes to us and they get such a good deal and go, wait a minute, this isn't reasonable. Well, I'm getting a good deal from my buddy. Well, what happens if your buddy leaves town?
Yeah.
Okay. See, this is our collateral.
Right.
And we want to make sure that it's able to get done. And so we'll make them change that and bump it up.
Right. So, Allison, from your perspective, now, I'm not sure how many you guys are doing right now or what you have done, but what have you seen from a contractor's perspective regarding 2 or 3K loans that you like, or maybe some things that you don't like, or that you maybe can change, or that you would tell, a potential customer before they get into it?
Well, Dave and I were even talking before this, and the whole concept of the thing that I love the most is the concept that you can buy a house and have the whole renovation all under one payment. So many people out there, they have 6-7 credit cards, and then they're wondering why they're paying so many different interest rates. Well,
right.
If you get one loan that can cover the house that you're going to love, and all the renovations, I think that's the best way to go. Some things that, I don't like, but we deal with it as being a general contractor, is you do get the unforeseen circumstances. A lot of people will be like, what's going on? Oh no. You find this or that, in a ceiling or the walls. You'll run into that stuff, but that's why you have the backup of, if this were to happen, it's going to be covered. People need to realize, though, that unforeseen circumstances happen almost every time. But we try to be very transparent when we find stuff like that, so everybody's aware of what's going on. And it's just a really great thing to have with millennials coming in, trying to find a home that they want all fully upgraded at any time, but the market's too hot. You can't find those unless you're willing to put the penny down. And
right.
if you go into a property that you can see can be
has good potential.
Yeah, has great potential. Yeah. If you are willing to do that and take the time and get to talk to Dave here in regards to getting loans like that, it's very, very, very reasonable, and I think it's a great option.
That sounds great, and this is something that I've always thought about, even for my personal residence. Yeah. And I've always looked at first as like new construction. Oh, that's just out of reach. I can't do it. And then
it's a lot of money,
right? And then you have some loans for that work well, and it's actually not that far out of reach as most people would assume that would be. And then this whole 203K loan program where you can actually just stay where you're at or in the area, and you can make an addition or add a better kitchen, the bathroom, all the upgrades that everybody wants. Yeah. But you don't need to pay that top dollar. You can just stay within.
You can stay within your means.
Exactly.
And that's what a lot of people I don't think see. You watch HGTV and you're like, oh, you need so much money to do it. You need this, you need that. But it is actually very reasonable if you look into it a little bit further.
Is the loan process similar or same, or maybe how does it differ if I have a residence and I'm looking to just renovate it but not sell it?
No, the process is very similar. I mean, we look at all the same things. The only difference is now we're building in the cost.
What
of
happens to my original loan?
Oh, we pay it off.
Okay, so if I have a Wells Fargo mortgage, I come to you and say, hey, this 2,000 square feet, I need to go to 4,000 square feet.
Yeah.
What can you do for me?
The only difference with somebody who's looking at staying in their neighborhood and improving their house, whether it's expanding or just updating.
A perfect area is Edina, right? You can see up and down France.
Yeah.
That's what people are doing right now. Yeah. They're tearing down, all the way and then building new or doing major renovations.
Yeah, and now the renovation loan probably is not going to be used for a tear down. Mm-hmm. Different story altogether. Mm-hmm. Here's the big difference with somebody that's doing it as a refinance. Okay, The first thing I look at is I go, I will bring people in again. And I'll know their financial situation or have a pretty good idea what that is.
Yeah.
And I'll tell them right up front, look, there's more than likely a couple ways to do this. And one of them might be a second mortgage.
Right.
Okay. So I'm not going to rule anything out.
You're not going to rule it out. Right. Okay. Your job is to provide the options.
Absolutely.
And the solution.
One of the options would be a cash out first mortgage. Mm-hmm. Okay. So you're refinancing your mortgage and you're getting cash out.
Right.
Another option is a combination of one of those two and putting cash into the transaction. Everybody's situation is going to be a little bit different. Now, with those options, you're limited to the as-is value of the house, okay? So unless you have a bunch of equity that you can use or a bunch of cash, you're probably not looking at those options. But if you do, then one of those might make more sense, all right? The renovation loan, you generally want to have some equity, but you're also taking advantage of the equity you're building, and you're going to mitigate the amount of cash out of pocket. So if you've got a house that is worth $200,000, and after you're done, and I'm doing this off the top of my head, but I think this is pretty good example, one we did recently. It was like a $250,000 house. They owed low 200s. They put 180 into it. The after improved appraised value was 450. So we were able to do the entire renovation for very little out of pocket.
Right. I mean, that's a perfect, scenario. Great, but it can be done.
Yeah,
absolutely. I think the big thing is what I try to explain to people is that every situation is different. Not only is everybody's financial situation different, and their preferences different.
Right.
And a lot of times it comes down to preferences. I mean, it really does. And I'll tell people, look, it's not like one is right or one is wrong.
Right.
It's what's going to make you more comfortable. Which are you more comfortable with? And after we go through all the options, and again, my objective is not to say this is what you should do. It's like, here's what you can do.
Yep.
Now, ask your questions. Tell me what you need to know, and let's make you comfortable and go away so you can make a good decision.
Yeah, I think what's holding everybody back, and what held me back, and is really the fear. And if you have a good resource and a person that you can go to with many years of experience in this industry, that it can be done, especially if you partner with the right contractor, Class Property Services, and the right lender, you can get pre-approved and close on your loan within 30 days, depending on how long the construction takes.
Yep.
Let's just say an average of 2 months is the average renovation time, or 3 months, depending.
Usually for us, it's about 2 months. It all depends how big
on
it
the
is.
project, yeah.
So within like the 4 or 5 or half a year, you can get your quote unquote dream home.
Absolutely.
And
It's
in the
very
best case
reasonable.
scenario, little to no money out of your own pocket, depending.
Yep.
The appraised value is higher, and with the state of the market right now, there's a good chance that's going to happen.
Yeah.
So to wrap this up, Dave, how can people get a hold of you? We're gonna enter all your info as well, so if you're listening while you're in a car or wherever, you'll have a link to his email, his website, and everything. But if people want to reach out to you right now, how can they do that?
Well, people can always call me, 651-406-5008. If I'm not in the office, it rolls to my cell. So call, leave a message. I will get back to you. They can email me, dsawicki, SAWICKI, at wintrustmortgage.com. Or they can check me out on Facebook, Dave Sawicki, Senior Mortgage Advisor and 203K Specialist.
Right, and we'll tag his Facebook page when we publish the podcast. So within a few days, all information will be available.
Excellent.
Thanks again, Dave.
Thanks, Dave.
Thanks for having me.
Yeah, a lot of good information, a lot of stuff that I didn't know, and now I'm learning, which is going to be fantastic because I want to do something like this too. I like the renovation aspect of the purchase. So
That's good.
Yeah. Do you have any other questions?
I don't, but I appreciate you coming in.
I appreciate you having me. It was fun.
All right. Thanks, Dave, and we'll see you next time, everybody.
Bye.
Bye.